Aaron Kohli, in your view, an impasse over the debt ceiling is a real threat. So what happens to stocks if it actually occurs?
I think one of the biggest risks to the market today is the fact that not enough people are paying attention to the debt ceiling crisis. I think if you get a situation where the debt ceiling is actually reached or breached, I think the amount of volatility in stocks and even in bonds to some extent will be very extreme. And the worst part about this type of volatility is it's very difficult to predict. Not only would the potential losses be random, you could have perfectly safe institutions that suffer losses, you may also have a situation where some equities do better and others do much worse depending on the cash positions and the safety of the securities versus the fact that the US Treasury may not actually pay its debt.
And how will the Fed react? Because clearly Congress can't come to an agreement, so people are going to look to the Fed again.
Absolutely. And I think this is one of the key situations where we may be asking the Fed to do a lot more than their original mandate suggests. So one of the problems that I think would come from this, and I think one of the reasons why equities may actually do better in this kind of scenario, is that it may actually postpone a lot of what the Fed is going to be doing. Now, right now, most of the market expects a hike later in 2016, but if, for example, they were to hike in December, you may be in a situation where the market expects this volatility to postpone their eventual date of hiking, which may actually end up in the short term being very good for equities.
So what does this mean for the whole data dependency of the Fed? Because we've had some data lately. We've had a CPI which came in below forecast. The core was a little bit stronger, but still below forecast. So what is the Fed seeing in the data?
I think what's difficult for the Fed right now is that the rest of the US economy seems to be decently strong. Inflation certainly hasn't been one of those components, but the labor market has been very, very solid. And so the result of that is that the Fed is ready to go. The Fed wants to go. The problem for them is if you get an exogenous event like this, it makes it very difficult for them to lift off on the basis solely of monetary policy. They have to consider these shocks and what the secondary implications of that may be, which could actually mean a much slower economy in 6 months.
Here's another shock worth thinking about. Is there too much debt in the system? Because over the past few years, every government, every corporation has sold debt to raise money because money is cheap. Is there going to be an overhang at some point?
Absolutely, and I think there are a couple of important dimensions that you can look at that. The first one that you pointed out, in the US, you've got three major sectors, in my estimation. There's households, there's the government, and then there's corporations. And of those sectors, two of them have actually increased their debt load in the last few years. This is when rates have been as low as they possibly can be. And the other dimension that I think you can look at this is international. Countries like China have massively increased debt over the last few years. So the real question you have to ask is what happens to these same borrowers when their rate of borrowing actually increases? And the picture is clearly not pretty.
All right, so what's an individual investor to do? We've offered a lot of things here that may or may not happen. So how should an investor structure their portfolio right now, especially on the fixed income side?
I think on the fixed income side, I like safer assets, longer dated assets. For me, I think you may actually see corporates get boosted from some of the uncertainty around the debt ceiling. And I think any delay in Fed hiking is only going to be gravy for bonds.
Right, but will it help or hurt the treasuries, the fact that we have a debt ceiling impasse?
So I think the important thing for investors to keep in mind when they're buying specific treasuries is to stay away from the ones that have payments in the near future. Those are the ones that suffered the most in the last few crises. Those are the ones that most institutions will avoid in that kind of scenario. But broadly, the treasury market will do very well because of the secondary impact that it has on the economy, the negative effect that it'll have.
All right, well, thanks a lot, Aaron.
Thank you.
Thank you for watching The Street.